Hello, guys. Just doing a sound check um, to see if everybody can hear me. Okay, very good. Okay, 1 second. Okay. So first of all, thank you for coming. Really appreciate you being here. I have a very special guest here. Before we start the webinar, I just want to remind everyone, and I'm going to do it here with the link. Just bear with me 1 second. Um, I just want to remind everybody that there's a substantial risk of loss in futures trading. Past performance is not indicative of future results. You should only use your risk capital in trading, which is really important, and basically get very, very educated in the business. I know that Kevin will also go over the disclaimer before we start, and and he'll go over that as well in a minute. So what I wanted to tell you is basically I have a very special guest with me here today. His name is Kevin, Kevin Davey. I've known Kevin, I've known of Kevin for many, many years. I also seen him in many places, and we also have a lot of industry acquaintances that we know. I was always impressed with his credentials, and a while back we kind of started corresponding and talking. Kevin's knowledge of automated trading, writing programs, and doing things that are related to automated trading is above your average trader. And the reason I wanted to bring him here today is because I believe that automation is really the way to go for many traders. There's a lot of traders out there that they struggle, that their emotions take the best of them, and the other side of trading today is completely algorithmic, high frequency trading. Those of you who trade and have traded in the last, I would say, week and actively trading, you've seen how volatile the markets have been. Every time, the market quiets down and you think now it's going to bounce back, it makes new lows. The day it started with new lows, turn around to make new highs. So it's very, very hard in general, to trade in that kind of an environment. So I like to bring in Kevin to talk about automation, somebody who actually trades real money, doesn't have hypothetical ideas about the market, but really practical ideas. Kevin won a lot of trading championships that, as I've indicated in the email that I've sent to you guys. And basically, he is going to talk about how to build a system and so forth. Now, the one thing I will tell you, and we will advertise it also at the end of this webinar, if you wish to trade Kevin's program through us, you can. We will give you his entire performance for last year of 2015. The results are real, net of commission, subscriptions, and everything else. Last year, Kevin made with, according to the site of Striker, where we utilize his system there, he made on, I think the minimum account size is 30,000. He made $26,000, 754,000 so far in the year. The published results are 1,092. And again, there's a substantial risk of loss in futures trading. Past performance is not indicative of future results. I will send everybody the page as well. Let me just place it here. Just 1 second. Okay. This is the performance report. So I just wanted to show you, at least you're dealing here with a person that, again, doesn't not only has theoretical ideas about the market, but he actually implements them in the trade and so forth. So Kevin, thank you for coming here, buddy. Really appreciate your time. Always enjoy talking to you. And I will turn off my mic and give it to you. And if you can read the disclaimer, I would appreciate it as well.
All right. Thanks, Matt. Just want to make sure everybody can hear me. you can hear me, just type a quick Y in the chat. Okay, perfect. All right, so today I'm going to talk about just some of the basics of automated and algorithmic trading. People, I think, get scared at this whole thing and think they have to be this computer programming genius to do this. And kind of what I'm going to show you today is you really don't have to be. It can be a lot simpler. And actually, my philosophy in a lot of things in trading is simpler is better. And I think you'll see that today. So again, I just want to thank Optimus Futures and Matt for sponsoring today's event. He's the reason we're all here, so thanks a lot for that. And what we're going to do is first I'm just going to kind of go over some of the things that Matt had already talked about who I am, and give you a little more detail. And then we're going to talk about the basics. We're not going to get into a lot of depth here, but it's going to give you a good understanding of what this means, because I think there's a lot of misconceptions about what automated trading is, what algorithmic trading is, and that kind of thing. And then we'll have some time for questions and answers at the end. And so if you have questions along the way, you can type them in, but I won't get to them till the very end, and that way we'll make sure we keep on schedule. So, as Matt said, the disclaimer, I won't read this all, but you definitely want to take some time to read it. The biggest things here: don't trade with money you can't afford to lose. Past performance is not indicative of future results. Those are two big things. And then hypothetical results. Treat all the results you ever see as hypothetical. I could tell you what my accounts did, but to you it's hypothetical because it hasn't happened to you. That's always my rule of thumb. Anything that hasn't happened in my own account is hypothetical. So, and there's a lot of things with, especially with algorithmic trading, with high coming into play, and everybody has seen these beautiful looking equity curves and that type of thing, and just remember, a lot of times those were built with hindsight, and of course they're going to look good. So that's something to keep in mind. But this disclaimer is something, if you haven't spent some time thinking about what it means, do that, because it's a big deal. Okay, so as Matt said, I do quite a few things, but the biggest thing I do is I'm a full-time trader. Everything else for me is part-time. The writing I do, magazine articles, even the book, and then I do some teaching and consulting. I've been trading about 25 years. The last 8 or so, or maybe it's 7, have been, I think it's 8, has been full-time trading. So I was able to make that leap that everybody wants to make from part-time to full-time. And 3 years straight, I had over 100% annual return in a worldwide futures trading contest. And that's a year-long contest with real money. So I was able to do pretty good 3 years in a row with that. If you've ever seen the book, The Universal Principles of Successful Trading, it's a really good book. I'm profiled in there as a market master, along with some people who are legends, people like Larry Williams, that kind of thing. But I'm in there. You probably see my articles in Modern Trader magazine. Used to be Futures magazine, now they changed it. And if you ever hang out on futures.io, which used to be Big Mike Trading, or on the Tradestation forums, I have the same nickname there, Kevin K. Dog. So, I'm always answering questions and people trying to help some people out, because I'm trying to pay some of it back of people who helped me out way back when. I have a book out. It was released in 2014. It's called Building Winning Algorithmic Trading Systems. It sounds complicated, as I'll show you today. It's not really, but there's some quotes from some people who read the book who I hold in pretty high regard. Dr. Van Tharp for one. And that book actually won the Trader Planet Book of the Year in 2014. And it's actually been a bestseller at Amazon for a little bit of time. It keeps dropping down and coming up. But, it's probably worth checking out. Okay, one of the other things I do is a lot of my process is pretty rigid as far as developing strategies, developing these algorithmic strategies. And I have a process I call the strategy factory, which if you think about a factory, you bring raw material in, you work on it, and out comes your finished product. And that's the way I treat all this algorithmic mechanical strategy development. It's a step-by-step process. You take a trading idea, you put it through some tests and some simulations and that kind of thing, and either out comes a good strategy or junk. Most of the time it's junk, but it's a pretty rigid process. So I'll probably mention that once or twice there, but that's what I mean when I say a strategy factory. So today's talk, what we're going to talk about are the basics of this kind of trading, the algorithmic and automated trading. We're going to talk about some of the advantages and disadvantages, because it's not all good and it's not all bad. And, maybe you're thinking, hey, I should do this kind of trading. Well, I'll give you some pointers on who should consider it and who shouldn't. And if you want to get started and learn more, we'll do that. And then we're going to build a quick system. It's not going to be something you can really trade, but I just want to show you how it's done and maybe remove some of the mystery from it. Okay, so first, what is algorithmic trading? So, just looking at Wikipedia, the first part of that's an algorithm. And all an algorithm is just a step-by-step operations of something to do. So it can be a computer algorithm, that's how most people think of it, but an algorithm could be you waking up in the morning, you wake up, you brush your teeth, you go to the bathroom, you put on your clothes, you put on your shoes, you go out the door. It's a step-by-step process that's basically an algorithm. But most of the time you're going to hear about it in relation to computers, because what the thing computers do great is run through loops and do these algorithms and do calculations over and over again. And that's what you can use to signal your trades. You put rules into some software, if this happens, buy, if this happens, sell or sell short, and then you run it. Now, most people think algorithm, and they kind of get scared and they think, oh, it's got to be this high frequency trading, where I'm in and out in split seconds, and I have to have co-located servers and all that. Well, that's part of it, but it does not have to be how you do it. And in fact, I don't do anything like that. I do not do any kind of high frequency trading. The highest frequency I get is I have a few intraday systems, but they usually trade 1 or 2 times a day, and that's it. Most of my algorithmic trading is actually swing trading, where I'm in a position for maybe a week. But it's still an algorithm because it's still computer rules that tell me what to do. So that's what algorithmic trading is. So the question you got to ask yourself, how do you trade right now? Do you use a chart? Do you use guidelines and principles on the chart? And your guiding principles may be trend line trading, and so you generally follow that approach. Well, if you do, chances are you're probably a discretionary trader, where a lot of your decisions change depending on the context of the charts and maybe even how you're feeling that day. Maybe it's a news story you heard that makes you think, well, I can't buy today even though the trend line looks good. So that's more discretionary trading. But maybe you take certain setups but still override them. Maybe there's a certain setup where you say, hey, 3 up candles in a row, I'm going to buy. Okay. Well, that's basically kind of like a little rule or an algorithm. And if you still override them on occasion, then you're what I would consider this discretionary and rule-based. You're kind of a hybrid. You're kind of using rules, but you're kind of using your own experience, intuition, whatever you call it. But that's another way to look at it. And then you could also be a person who just follows the rules exactly and never deviates. And that kind of person would be what I would consider an algorithmic trader. So you can see there's this continuum of discretionary where you're just going by these principles, and then somewhere in between, and then you're going to algorithmic, which is following the rules exactly and not deviating. So when I talk about algorithmic trading, there's a whole bunch of different terms for it. You might have heard mechanical trading, rule-based trading, systematic trading. They're all the same thing. And the point is, you create rules and you follow them exactly. That is pure algorithmic, mechanical, systematic trading. You just create the rules, then you follow them. Of course, it's very hard to do, right? Anybody who does this kind of trading will tell you sometimes it's really hard to follow your rules, but you really have to. And I'll get into that in a little bit of why you have to do that, but that's important. A lot of different software will help you do this. Tradestation, Ninja, multi-charts, Trade Navigator, the list goes on. And some of them let you just test, some let you test and automate, which is take the trades for you. There's a whole range, and I'm not here to tell you which one to use. I will tell you which one I use, and that's Tradestation. And Tradestation's probably been around the longest of all those. It was probably the original one. And the great thing about Tradestation is it's pretty easy to learn, I think, for most people, especially non-computer programmers, where some of those other platforms, you have to really get into some of the details of programming. What somebody told me once is Tradestation was written by traders for traders, and some of these other software packages were written by programmers for programmers. And hopefully you understand there's a big difference there. We're traders, and so we don't want to have to spend our time figuring out how to program it. And you'll see that a little bit later. I'll show you an example with Tradestation Easy language, just how simple it actually can be. So those are the basics. The algorithm is just a set of rules, and then the automated part, which I didn't really discuss too much, you can just have the software automate it. There's a couple little switches you can do, and you can have it take the trades in real time as dictate, and then it becomes automated, and you really don't have to do a whole lot other than monitor the positions and make sure everything's synced up. And of course you have to do rollovers, and when there's disconnects you might have to take some action, but for the most part when you do automated trading it eliminates a lot of that. And it's good for a lot of reasons. Well, one of the advantages is you can test the rules yourself. You don't have to rely on some guru who has a trading room or something that says, oh, you must do this, or some guy that's a price action guru that you have to follow him, and you never really know if is he really doing that? Is he really trading? You don't have to worry about that. You test the rules yourself. You do it yourself, and you get the results. And the results are either good or bad, right? But you know what went into it, and you know how it ends up. And there's a huge benefit to that as far as your confidence goes. You know, when things go bad, and things always go bad, you know, you're always going to have drawdowns. You'll have that to rely on. You'll be able to say, well, I know I tested this over 10 years, and yeah, there's drawdowns, but so what? There's drawdowns, but that's to be expected. And I test it and I have confidence in it, so I'm going to keep trading it. Where if you were following a trading room, for example, and it started going down, you might start to panic. Maybe this guy's lost his edge. Maybe he doesn't know what he's doing. Oh, maybe I should stop following him. That kind of thing. So when you create an algorithm and you test it, you're relying on yourself. And I think ultimately that is really key. The other nice thing is you can create a lot of strategies. You know, some people think they have to create this holy grail mother of all strategies, you know, one that will do everything and work in every market and work all the time. My experience is that doesn't exist. And the people who look for it are the ones who get in trouble. You know, I know people who have one strategy that has 30, 40,000 lines of code to handle all kinds of conceivable price action and things that happen in the market. And I'll tell you what, they're not making money with that. A good way to make money with algorithms can be to create a whole lot of strategies, you automate them, and then you become diversified. And you know, you've probably always heard many times about the stock market and how to be diversified. You know, you want to own so many different stocks. You don't want to put all your eggs in one basket. Well, it's the same thing with futures. Same thing. The benefit, though, is there's probably even less correlation between futures markets and stocks. You know, if the stock market crashes, pretty much everything's coming down, right? Most of the time. But with futures, you could be trading coffee and cotton and soybeans and U.S. 30-year bonds. And the chances of all those lining up, if you have different strategies and you know them all going bad at the same time, is a lot less. And so you get this diversification effect, which smooths out your equity curve. It's a huge advantage to this type of trading. Another point, and I talked about this a little bit earlier about confidence, but knowing how something performed historically is a huge confidence boost because you can go back and draw on that. So just my own trading, for example, right now, the beginning of the year, I'm in a drawdown, okay? Not the best way to start a year, but I'm also not worried about it because I know historically, yes, I've had drawdowns. I've had drawdowns a lot worse than this. So, and it's always come back. And I have the confidence to keep trading my system. I'm not panicking, thinking, oh boy, I gotta change my systems. I gotta do something. No, you just keep trading. That's something you get when you go to this algorithmic trading. You don't have to be glued to a screen. How many discretionary traders do you know who, you know, spend 4, 8, whatever hours a day just focused on charts, watching every little tick? Well, you don't have to do that when you're doing this algorithmic trading. Not at all. I mean, I still am doing this full time, so I'm doing things during the day, but I guarantee you I'm not looking at every tick. You know, I check charts and strategies a couple times a day, and I'm off doing other stuff, meaning developing systems or doing some other kind of research into how to improve my system development, that kind of thing. I'm not glued to a screen watching prices, and that's a big deal, I think. Of course, there's also disadvantages. You know, the biggest one is developing a strategy the wrong way. And so many people do this. And I'll give you an example in a little bit how that happens. But let's just say the way most trading software is set up, it encourages some really bad practices. So you got to be careful. And of course, just because you have a good historical back test doesn't mean it's going to work going forward. You know, that saying in the disclaimer, past performance is no guarantee of future results. Absolutely, 100% true when it comes to developing any kind of strategies with a back test. You got to be really careful. And if you're not, you're going to get a nice looking equity curve and it's not going to mean anything. And you're going to think it means something. That's the worst part. You're going to think you're going to make money with it, but maybe you've over optimized. Maybe you have too many rules. There's a million different things you could be doing, and you won't get that past performance. So that can be a big disadvantage if you don't know that. The other thing is most people can't resist this, just tweaking their strategies. Oh, there's a Fed announcement coming up, so I'm going to turn the strategy off. But your back test never turned it off during a Fed announcement. So right there, you've tweaked your strategy. That's not good, because you do enough of that, and all of a sudden, all your back testing, you just throw it away. What you're trading is not what you tested, and that's awful. That's one of the worst things to do. And maybe you'll say, well, after a couple losses, I'm going to go back and update the strategy and tweak it. People love doing that, and that's another terrible thing to do. You build your strategy and you run it until you determine it's broken. That's my philosophy, and it works. That philosophy works really well. The philosophy that doesn't work, at least in my experience, is take strategy, and if it doesn't work after a month, go back and modify it and try it again and go back and modify it. It just doesn't work. This one's a really big one. Overruling your strategy. People will spend hours and hours and weeks, months, whatever, developing a strategy, and then they'll turn it on live, and soon afterwards, it'll be overruled. They'll turn it off or something. And I'll give you an example. There was a guy who lives not far from me who I met a while back for coffee, and he was showing me this Forex system he had. And he was showing me the backtest curves, and I'm like, okay, well, it looks good. He said he was going live. So a week after he went live, I said, hey, how'd you do? He goes, great. I made $500, and I think he had like a $10,000 account. I said, wow, that's pretty good. He goes, yeah, I should have made $2,000 though, but I got scared and turned my strategy off because I thought it was making some weird trades, even though they were per the rules. I didn't like them, so I overruled my strategy. So where do you think that trader's going to end up 6 months, a year later? Probably broke, and he's going to blame it on his strategy when maybe it wasn't the strategy's fault. Maybe it was the human who was controlling the strategy, right? So if you have the tendency to overrule your strategy, that's bad. The last disadvantage is really a misconception more than a disadvantage, because a lot of people think that they can just set it and forget it. And I think there's a platform out there with these expert advisors. You've probably seen them, especially with Forex. And they claim, oh, hey, you just turn this on, let it run. And you see all these internet ads of these people. Yeah, I just got the software, installed it, turned it on, and I'm making, $300 a day. Yeah. There's no such thing as set and forget. Set and forget usually means set, forget, and lose everything. Because things go wrong. And there's things you have to do. With futures, you have to roll over. If you're trading crude oil, you're going to be rolling over every single month. And that means you've got to go in and probably manually adjust your positions and then get the strategy synced back up, change the chart to the latest month. There's work there. It's not set and forget. And people who think that either haven't traded or just want to sell you something. So just remember that that's a misconception. You are still going to be doing ongoing maintenance and stuff, but it doesn't have to be extreme. And certainly automation helps a ton. The bottom line, this kind of trading is not for everyone. If you have a tendency to overrule and, don't trust your rules, don't even think about this kind of trading. You're just going to be worse off. Like I said, some people are just better off being discretionary traders. And I'm not saying they'll necessarily be successful, but they might think they'll be successful. And, I just give you an example from my own trading. When I first started doing some of these systems, I was only doing a few of them, so I was able to watch every signal. Now I'm at the point where I have so many strategies, I can't watch every single one to see if, it's going to make a trade kind of thing. But back when I was doing a couple strategies, I could see that. And I could see, an ES strategy was setting up to buy, and I remember thinking to myself, why is it doing this? This is awful. And the feeling to overrule was pretty extreme. And sometimes I would do it way back then. And it almost always worked out bad. When I thought I was doing good at overruling, I actually made things worse. So if you have this overruling mindset that you think you know better than what you've tested, my advice, don't even try this kind of trading, because you're just going to get really frustrated and probably lose by overruling it. The key with doing this is to let the system be the system. Okay, so along those lines, should you even consider this? Like I said, you got to follow the rules exactly all the time. If you can't do that, don't even do it. Can you develop a strategy properly? Are you willing to take the time to do that? And do you know how to develop it properly? If you don't, if you think it's just putting a chart up and running an optimization, it's probably this, you shouldn't consider this, because that's not how to do it. If you tinker with strategies, if you want to go back and create the perfect back test, and that's your perfection mindset, don't do it. Engineers, I have an engineering background, but engineers, math people tend to think there is an answer to the markets. There's an answer. There's one perfect answer that will solve this, this being the price forecasting, for example. And if you think that way, what you're going to do is go back and change and modify your program and keep making it better, what you think is better. And, that works in a lot of fields where you go back and improve things. If you're writing an app for the Google store, going back and making improvements usually is a good thing. But if you're developing a strategy, tinkering with it, making improvements, usually not a good thing. And the last thing is, you really have to have this level of, I guess excitement's a good word, where you want to develop multiple strategies, because that's the whole goal. You're not going to develop one strategy and then stop, because strategies break. They break all the time. Last year, for example, I would probably say I had maybe 5 strategies break out of around 80 or so that I'm trading. So I had to retire them, but that's okay. That's just part of it. My philosophy is no strategy lasts forever, and things that work now may not work 5 years from now. So, I'll stop trading it. And there was a question that came through about when to turn it off, and I'll try to have time to hopefully answer that at the end. But you really have to be excited about the development process. And if you treat developing these algorithmic strategies as a chore, as, I got to create another strategy, I don't want to do that, you're not going to last. You got to do what you like doing, right? And that that goes true with anything, right? Anything in life. You gotta love what you do. And if you don't love developing strategies and seeing, um, how you can make a great equity curve or a good equity curve, don't do it. Because this is really frustrating. I've been doing it for I don't know how many years. Well, 10 years with Tradestation. I've been developing strategies, and I'll go sometimes for a month or more without developing a new strategy. And then I step away from it usually and come back, and maybe I'll create 3 or 4 or 5 in a month. Um, but sometimes I get so frustrated I just can't develop anything. So keep that in mind. I love doing that. I love developing strategies, and so for me, the frustration is just all part of it. But I tell a lot of people it's kind of like Edison when he invented the light bulb. He just found all these ways that didn't work, and he continued to develop and create try new materials, and that's what you do with strategy development. And if you don't love doing that, you're going to have trouble. Okay, so I'll just take you through an example here in the next 10 minutes or so, and then we'll have some time for questions and answers. But let's just walk through an example just to kind of demystify some of this, this word algorithmic trading, automated trading. I'll show you real simple how it's done. Okay, first you got to get the software and the broker, right? You need that. You can do Tradestation. For the software, you can do it through Optimus Futures. That's a pretty good choice. Again, Tradestation was the original. They have what's called easy language, and to me, it's pretty easy, and you'll see that in a second. It's got a great community of support. You can ask other users like yourself who are more experienced, hey, how do I do this? I'm on there answering almost every day when people have questions. And of course, Tradestation has all kinds of support and that kind of thing. And that's the second step, is actually learn the software. Learn the basics of the charting, learn the basics of easy language. Tradestation has a ton of stuff on their website where you can do that. Videos, there's documents, there's all sorts. There's live webinars, all sorts of stuff. Because you really want to learn the ins and outs. What I always tell people is, you're pretty good when you can create a system with your software that is totally bogus. And some people look at me and they're like, what? Why would I want to create a bogus strategy? Well, my point is, if you can create a bogus strategy, that means you know some of the pitfalls and some of the tricks to it. And in that case, you know your software pretty well. The people who get in trouble don't know their software at all. They don't know it well enough. They don't know how to flip the switch for limit orders so that limit orders become realistic. Okay, and you might be saying, well, what's that? Well, that's one thing you got to learn with the software, right? So you learn the software. That's step 2 after you pick it. Then you develop a strategy. Unfortunately, here's what most people do. They get this back test that, hey, it's going up and to the right, perfect. And then, let's say at this point they start, this is what they have. They have this chart, and they're like, I'm going to start trading real money. And of course, a lot of times this is what happens. And you might laugh, but hey, I've experienced that. So it does happen. And you end up like this guy, just completely frustrated because you're like, well, I developed a good looking equity curve. What happened? Well, you got to learn how to develop a strategy properly. And, I'm not going to go through all that today, but the point is there is a way. There are multiple ways. I use one way that I feel really comfortable with to develop a strategy. There's other ways out there, but what you don't want to do is just go and optimize to death and have 20 rules and then go and trade it. Give you a good example. There was somebody who was on the Tradestation forum a while back and said his question wasn't about strategy, it was about computers, and said, well, should I buy a faster computer? It's taken me all weekend to run an optimization. And I saw that, and I'm like, whoa, that's a long time to be running optimization. So I was like, well, how many variables are you optimizing? And he had something like 20 or 30 variables he's optimizing. He had millions of optimization runs. And I was like, dude, you're just doing it all wrong. And of course, I probably didn't say it nicely enough because he's like, oh, you don't know what you're talking about. But, if you have 10 or 20 rules, which a lot of people do, you have way too many. I like to develop systems with maybe 1 or 2 entry rules, 1 or 2 exit rules, 3 or 4 optimized variables, and just go with it. The problem is you don't get a super smooth equity curve. You get a little more jaggedy equity curve, but that tends to work better going forward. And ultimately, what are you trying to do? You're trying to get something that works best in the future. So you got to learn how to develop a strategy. And ultimately, however you do it, it's the real-time results that are going to show that you're doing it right or not, right? However you do it, if you don't prove that method with real money in the markets, you don't know what you have until you do that. Okay, so here's an example. So I just pull up a crude oil chart, and I'm running it for the last 8 years. So there's my chart. That's pretty simple. And I just put some rules. So I'm going to develop a strategy. Now I'm just going to use a simple momentum-based strategy. If the close is greater than a close a number of days back, buy. Meaning, if we're in an uptrend, buy. If we're going down, sell short. Put a simple stop loss, $2,500 per contract. Simple profit target of 5,000. So we're going for these 2-to-1. Over time, you want your winners to be twice as big as your losers. Okay. Yeah, I don't know. It's just a strategy. I'm not saying it's good or bad. But this gives you an idea how simple it is to program something in Tradestation. You could have a strategy that is literally this simple. And it's just a simple momentum-based type thing. And you apply that to a chart, and all these nice trades come up. You see there's some red lines, which are some losing trades. Well, there's a bunch of winning trades here. It catches these downtrends really nice. It has problems in the middle. Most trend following systems do, right? So pretty typical. Take a look at the performance results. Over this 8-year period, it actually would have made $109,000. Again, all hypothetical, and this isn't a real system, but just gives you an idea of what you could get out of this. And would it win 37% of the time, which is pretty typical for a trend following system, which is what this is. So, I went from putting up a chart, applying this real simple strategy, and got the results, got a performance report. Okay, now let's just say, I'm not saying this is the way to do it, because I do walk forward testing, and there's a lot more in-depth stuff that I don't have time to talk about today. But let's just say you decide, hey, I want to automate this strategy. How do I do it? I want to trade it live and let the computer interpret the rules and tell me when to buy and sell and just do it for me. In Tradestation, it's really simple. So you have the strategy applied up here, and you've turned it on. It's kind of hard to see here, but this says on. Then there's a couple boxes where it says generate the orders and then automate execution. You just check it. You got to tell it which account. You got to turn confirmation on or off. And there's some disclaimers you got to click through the first time. And that's it. And then that strategy's running live, and it will take trades just as your rules say. And that's the automation part. So as you can imagine, the tough part is getting to the automation part. It's actually getting the system that's developed properly, that has a decent back test that you think's going to work. Then automating it's just doing a couple clicks and there you go. All right. Well, that was a simple example. Of course, I left out a ton of details. What is good? What's a good strategy? What's not? How do I know I'm doing things right? How do I avoid over-optimizing? Should I do out-of-sample testing? There's all sorts of questions. And a lot of those are things you know to ask at this point. So, but that's way beyond, this webinar is just the basics. And the basics, I just showed you. It's as simple as that, but it obviously gets a lot more complicated when you start looking at this kind of thing. Just to give you an example, what's a good equity curve? Well, you've seen it on internet forums where somebody will post their equity curve. Is this good or bad? Don't fall for that. And meaning, don't try to help somebody and say, oh, that's good, oh, that's bad. Because the real trick is not what the curve looks like, although that is important to an extent. It's how it was developed. So you give me 2 minutes, I could come up with a curve in Tradestation that would blow you away. It looks so good, you'd say, oh, I'm going to trade that immediately. That's the best looking equity curve I've ever seen. But the point is, you don't know how it was developed. And I do, because I know some of the tricks in Tradestation where you can make these great looking equity curves. So it's even more than just knowing what is a good looking performance report. It's knowing how it was developed. So those are some of the keys that I just kind of left out. The big thing, don't do this. This is what most people do. They call up a chart, they insert a strategy, they optimize it like crazy, and they trade those results as soon as they're done with the test. What I'm saying is, don't do that. There's just so many bad things in there, it's ridiculous. But that's also the way the software's set up. I mean, the software makes that whole process very easy. And that's the tricky part, because you say, well, hey, it looks so easy, I should just do it. And no, that's not the way to go about it. So take some time if you get into this and learn the right way to develop strategies. And again, the right way might be different for different people, but ultimately it's going to be what works for you in the markets. And so you got to have that feedback loop that, hey, I'm developing strategies and yes, they are working in the markets, or no, they're not. Okay, so maybe I have to do something different with the way I develop strategies. But eventually you want to get to the point where the market is giving you the feedback that you're doing things right. Then you'll know you're in a good place. Okay, so just to kind of wrap it up, we talked about the basics of what's algorithmic trading, what's automated trading, and some of the advantages and disadvantages. We also said, well, who should consider it, who shouldn't, and we kind of walked through an example of how to actually do it. And hopefully now, if it was kind of a mystery, it looks a little bit easier to you. But read that last point in red. It's very hard to do correctly. Just because you have software and just because you can create these equity curves doesn't make them good. It's the old computer programming saying of garbage in, garbage out. And if you have bad practices and do things the wrong way, you're going to get garbage for results, even though you think they're good. So keep that in mind. So if you want to start, what's next? What do you do? Well, first I would research platforms and brokers. Look at their languages and try to come up with something that you feel comfortable with. A a good magazine, Technical Analysis of Stocks and Commodities. Usually in the back of every issue, they have different programming languages, different platforms program a strategy. And you can actually see how they all code it differently. And so you can look at it and say, wow, I like the way this code, I can kind of understand this, where this other one, man, I don't know what's going on. That might help you pin down what you want to use. Like I said, I use Tradestation. I've used it for 10 years, and I'm not going anywhere quickly outside of that. Read some strategy development books. I put my book in there as a shameless plug, but Bob Pardo, probably wrote the Bible on it. He does a lot of things differently than I do, interestingly enough. Tomasini also wrote a good book on system development. So they're out there. Read about it, learn about it. Then at some point, you might decide to get some advanced help. But that can wait down the road. You want to get as far as you can with, the quote unquote free stuff or, books. That's a pretty cheap way to learn. And there's a lot of good advice in those books. And then you finally get to the point where you create a strategy, and then it's just a repetitive process. You create that first strategy, and then you lather, rinse, and repeat, right? It's like shampoo. You just keep doing it. You create that second strategy, third, fourth, fifth, sixth, seventh, eighth, ninth. That's what I do. I just keep creating new strategies, and I get better at it. And also some the strategies get better. But you got to kind of do that. So that's pretty much all the prepared remarks I had. If you have questions that I don't get answered, because I see a bunch of them here, feel free to email me. Like I said, I'm working full time, but I'm not glued to the screen, so I can probably answer at least simple questions via email. So it's kdavy@kjtradingsystems.com. What I'll do now is take a second. If you have questions, type them in, and I'll give you guys a few seconds. I'll start answering some of them. Okay, a couple questions here. System being broken versus having a rough period, or Bill's asking a different way. How do you determine a mechanical system? It's time to turn it off. It's a little more depth than I can really talk about today. But what you can do if you have a back test that is representative of what you're getting in the future, meaning, it mimics orders correctly. It's not playing any games with like limit orders and that kind of thing. There's some statistic measurements you can do to actually show if a strategy is broken, but a simple way is you take your back test, and let's say you had a $10,000 max drawdown sometime in the past. Well, maybe you say, I'm going to turn it off because I think it's broken if I get a $15,000 drawdown, 1.5 times. They always say your worst drawdown's in front of you, so that might be a good criteria to stop. You could say if there were historically 5 losses in a row, maybe when you get to 8 in real time, you say, I've never had this before. Maybe my system's broken. There's a lot of different metrics you can use, and I'm not going to say one's better than the other because I've never found one that said, oh, this tells me the system's broken. But the key is that you do that. Most people don't. Most people will create a system and never think about what happens if it goes wrong. And you really need to do that. You have to know when to quit. And as long as you're consistent in your approach, you're probably going to be okay because it's going to save you from ruining your account due to a system, underperforming, stop performing. So those are a couple things I use. Steven's asking, how long on average does it take for me to go from a trading idea to trading live? Usually that process is uh, 3 to 6 months. It depends. I like to do something I call incubation, where I create the strategy and then I set it aside and let it run live without money, but I'll go back and check its performance once a month and make sure it's still performing. That's kind of the ultimate way outside of real money trading to make sure you haven't somehow introduced some kind of hindsight bias into your back test. You're letting it run live on unseen data and see how the strategy does. So it's usually, I'll tell you the strategies I'm creating today, I'm not expecting to trade for probably at least 6 months, maybe even longer. I won't be creating one today, and if I finish one today, I won't be trading it tomorrow. That's for sure. Let's see. Okay, let's see. First, Steven's asking, do I have any advice if I elect to lease or buy a system? That's always a tough one because you're putting your hands into uh, a developer's mind, and you have to be careful. I would research the developer quite a bit, make sure they have a positive history, and then look for as much real-time performance. So, Matt had mentioned I have a system on Striker, and that's real money. And so that's what they report. It's not hypothetical that some other sites might show, and certainly not what a lot of independent people out there who are selling their quote-unquote mystery, holy grail black box system. I would try to verify everything you can has been done with real money. Now, it doesn't tell you you're going to succeed, but I'd much rather trade a system that's real money than not. Bill has a question, talk about walk-forward testing. Basically, that's just a method to ensure that you're not basing your results on in-sample optimization. So walk-forward basically is a method to get out-of-sample results. And if you don't know the difference between in-sample and out-of-sample, I don't have time to talk about it here, but there's a huge difference. Think about live trading tomorrow. That's all out-of-sample. But today, if you went back and said, I would have done this, this, and this, that's in-sample. Huge difference. And walk-forward allows you to get a lot of that out-of-sample. Steve asks another question. Can Tradestation handle multiple time frame rules for strategy entry? And the answer is yes. You can do a lot of things with multiple time frames. It just gets a lot more complicated. I do a few of those, but normally I like to stick with one time frame. A lot of my systems happen to be daily bars. That tends to work pretty well. Kevin's asking, how far do you back test? How long a system more typically? It depends on how much good data I can get. And the reason I say that is because let's say you're creating a system off 10-minute bars. You're going to probably use obviously now the markets are electronic, but back 2007, 8, depending who you talk to, there was this transition from mainly pit trading to electronic trading. So depending on your data source, it might be that the data, there isn't as much intraday data as there would be today. So you got to be careful with that. If you're just using like daily closes, you can go back, way back, because electronic sessions and pit sessions were always the same settlement price. So it kind of depends on your data. I like to go back to 2007 or 2008 for most of my testing these days, which gives me roughly 8-9 years of backtest history, which is pretty nice. Things like the mini S&P, though, I know there's good electronic data going back to 97, so I'll use all that. So that's 18 years of data. And then how long a system lasts? I have some systems that I've been trading for like 6 years. I've been trading live. Some systems last 6 months. Some last a couple of years. You know, ideally they're going to last a few years, and in the meantime you're going to be building up new ones, so that if they start to underperform, you can just replace them. So there is no. I guess a lot of that depends on the person developing. So, but what I always tell people is, no matter how good of a developer you think you are, always plan on your systems breaking at some point. And if you go in with that mindset that nothing lasts forever, I think you'll be a lot better off. So let's take one last question. I'll turn it over to Matt because I know we're running out of time here. Let's see. Okay, now there's actually 3 questions. But what's the shortest time frame that works okay? You know, I have some systems that work off minute bars, but when you start getting into shorter time frames, it's a lot harder because there's a lot more noise. And I tend to go more towards daily bars. They tend to be a little bit easier. Are futures easier than Forex or options or equities? You know, well, options are really hard to test. That's the biggest thing. So I don't really trade options too much. I do some things with options, but you know, back testing any kind of option strategy is really tough because you got to have all the data, all the strike prices, and a lot of times options are so illiquid that there'll be a price, but there's no way you could even get an execution at that price. Equities, as long as you have clean data that accounts for dividends and stock splits correctly, you can probably test that. I don't do any equity short-term trading. I just do, you know, like real long-term trading with that. And then Forex, you know, the trouble with Forex, depending how you test it, like with Tradestation, for example, you can really get messed up because they only show the bid stream, data stream, and so sometimes stop orders or limit orders you can get fills in real time that you wouldn't get in back test. So one last question: how often do you tinker with the settings of live system? The answer is never, except I do walk forward testing, which means periodically you re-optimize the system, but that's on a set schedule. So I don't consider that tinkering because that's just, hey, every year I know I rerun the optimization. Tinkering would be more, oh, I'm going to adjust the rules midstream. So the way I do walk forward testing, I can tell you for the next 5 years for any of my systems when exactly I'm going to optimize it. And so that to me is not tinkering. And then the only I let it run, and if it breaks, then I'll stop. I'll stop trading it. So. All right. Well, if I didn't get to your question, you know, feel free just to send me an email, and with that, I'll turn it back over to Matt. Thanks, everyone.
Hi, guys. So, first of all, Kevin, thank you very much. It was very informative. Even though I've been many, many years in the industry, I always keep an open mind. I always want to learn things. Let me just go over some things with you and also address some of the questions that you had for Kevin, but from my perspective as a broker. The first thing I wanted to tell you is that we are an introducing broker to Tradestation. I'm going to put it over here. Okay. So it's right over here. If you want to open an account, I hope you'll reach out to us. We do not charge more than the standard commission that Tradestation does. We charge absolutely the same, and we follow their schedule, except that you will get a dedicated person here that will take care of everything for you. That's number one. Second thing is for those of you, so Tradestation is for those if you want to develop an automated trading program, you wanna, try your luck at it and so forth. And it's difficult, in my personal opinion. It's not any difficult than being a discretionary trader. I don't think if you're failed on, I mean, I shouldn't use that word, but if you're unsuccessful in, let's say, discretion, don't think that your transition to automation will not have its challenges. You have to learn the kinks, the ins and outs, and the testing and advantages and disadvantages of any single software out there that's given. So for those of you who want to go at it, I would never discourage you, but just understand you have a learning curve. For those of you who want to trade Kevin's system, again, I'm going to post it here. Okay, so we have it through either we can trade Striker through AMP, AMP futures, or through ADM at the moment. And if you want to follow a system that's there. One of the things that I wanted to tell you from my perspective, it's the same thing that Kevin said, we try our best to show amongst our system selections, and we have Striker, iSystems, to show real results of live results that have happened, not only the hypothetical component. So you have some sort of a realization. Any money you put in systems, any system out there, just understand one thing: it will have drawdowns. Even the best performing systems will have very volatile times. And so what I've noticed about systems over the years, what the public wants, and I'm calling you guys the public, the retail, they think that systems are there to provide some sort of a monthly income, and they're systems that can generate, let's say $500 a month. That's a myth. It doesn't happen. In reality, you have the good systems, they have really good months, and sometimes, some very bad months. And overall, there's a positive return that can occur. But at the same time, you have to be very realistic, and you have to withstand that. And the reason that I'm saying that is not to discourage anybody from doing a system. Quite the opposite. I encourage people to seek automation, but I also want them to come with the realistic expectations and not to close an account when there's an anticipated drawdown. So like Kevin said, when you backtest and you have a system, and I'm purely throwing an hypothetical number, but let's say you have a system that requires $50,000 and it has a $15,000 drawdown, and if you're down 5,000 on it, sure, it's your money, you can close at any time, but in looking at the relative performance of the system, that's the drawdowns. And in real life, drawdowns, of course, could be very different than hypothetical ones if you are looking at hypothetical models. A question that was addressed today with me and another customer, and we discussed that, is about all the asset classes. What's easier, futures or Forex or equities? I always have the same opinion. It really depends on your expertise. It really depends on your comfort level. Equities, for example, you can trade them without leverage. It might be more suitable for your nature. Futures trading is, it involves leverage, so it's a different psychology and so forth. So is Forex, of course, that involves leverage as well. If you trade Forex, you obviously have to make sure that whoever you're dealing with has very deep liquidity providers to make sure that it's there when you trade larger lots and so forth. That's basically it. If you want to trade Kevin's system, get in touch with me. Here's my email. Can you hear me type? Okay. And I'll give you my phone number, toll free. I will be here for the next hour. This is local for those of you who are overseas. That's basically it. Do you have any questions for me as far as brokerage? I'll be more than happy to answer that. Or you can ask me about the services we have for automation or anything like that. And by the way, I wanted to tell you another thing. I truly believe, this is only my belief system, that it's almost impossible to write systems that are scalp trading. I believe I've seen good scalp traders, and I don't mean about the tick, and people who take a number of points. I think it's very hard to automate short-term trading systems. When people ask me, I try not to go that way. A system could still be day trading, but not necessarily trying to scalp. So, it tries to go for a larger number of points and so forth. I think that would make better automation. But of course, you have to test it, look at the results and so forth. And I don't, and just as a FYI, I don't force my belief systems on anyone. I really just share with you what I think could really potentially help you. Again, if you have any questions, please put it here. If not, I'll close the room in a few minutes, but I would love to answer anything you guys want. And Kevin, again, thank you so much for your time. I hope you'll come a few more times to help us out.
Thanks, Matt, and
Pleasure.
attending.
Oh, Brian, thank you. Thanks, buddy. Good seeing you here. Always good to see customers. Okay, I see there are no questions. So what I'm going to do is just wish you guys a good night. I look forward to hearing from you. Of course, you can either email me or Kevin. Would love to work with you guys together, and we'll go from there. Thank you, Bill, and thank you everybody who has attended. I really appreciate you taking the time to get educated. I really hope that what we do will help you in your own trading. I hope you'll become bigger and better. That's it. Okay. Thank you very much. I'll close the room now. So good night.